Hey everyone, welcome back to Above Board with Candor Path. Today on episode number 97, which by the way, Matt, like 97 is a good number. That's when Notorious B.I.G.'s Mo Money, Mo Problems came out. Do you remember that?
That's such a Rich thing to say. Rich is not joining us today, and we miss him dearly, though. Rich B. I would have expected that to come from him. I don't think
I learned from the best.
Yeah,
well, I learned from the best, you know?
he has the little quips that always come out. That one really came out of left field, and I do like it because when you do have Mo money, you do have Mo problems.
I totally didn't think about that all morning to how I would do that intro, but I did think it was appropriate for what we're talking about today. And we're going to do not so much a Q&A on money and market stuff, but we're going to talk about some things that have happened in the last year and whether it's stocks or bonds. And I think something that I wanted to maybe lead with, Matt, is discussing this term, the behavior gap. And for those who haven't heard of it, it was actually coined by Carl Richards, who's a pretty famous CFP in our industry. And it essentially refers to this idea that there's a difference between making like a wise financial decision versus what we might ultimately or actually do based on like our hardwired emotional state of decision making. So for example, someone might be inclined to double down in the markets when things are peaking, or they might panic sell when things are low. And we know that that's not a good idea. We all want to buy low and sell high. And a lot of times our emotional response is we do the opposite. And I guess the idea or this term came from like, you create this gap between like what you actually returned or made versus what you could have if you didn't allow your emotions to override your decision-making process.
Yeah, I love that quote, John, because I use it a lot in my meetings. I feel like our job as advisors, if you had to boil it down, there's a number of things that we do. But one of them is, and I say this all the time, is take the emotion out of investing and take the emotion out of finance. If you can remove that emotion and you can look at things not so much with your heart, but with your head, it makes it easier. Now, I can say that to a client and I can make a plan around it. I find that oftentimes it's hard for myself. And so I want our clients and I want our listeners to know we deal with that on our own personal financial plan. But I find, and I always kind of use the analogy of like a doctor who sees blood. I think I've used that with Rich a few times, where like if you go to a doctor and his like your arm's chopped off, he doesn't like freak out, or she doesn't freak out because there's blood gushing everywhere. They're like, okay, step 1 is we do this, and step 2 we do that, and step 3 we do this, and they go into like doctor mode. And I feel like we do that a lot of times in our profession. I remember right around 2020, and when COVID came out, I know we're going to talk about that a bit here as we kind of look back at the last 5 years. And it wasn't, oh my gosh, there's a pandemic, what we haven't seen since 1920. We don't know what to do. It was, hey, step 1, we do this, step 2, we do that, and step 3, and we sort of take it from there. And it was really interesting talking to our clients during that period of time, which we almost talked to every single one in almost a 2 or 3 week gap. And so many of them came to the table with, oh my gosh, Matt, what do we do? Let's hide underneath all the money underneath our mattresses. And often, in a lot of cases, we did the exact opposite. Those conversations started with that and ended with, okay, so you're saying now is the time to add? And it wasn't so much as making a call rather than looking at a portfolio and using our heads and using mathematics to determine if our weighting is incorrect, then there's a way to fix that. And let's go ahead and fix that inside the portfolio. So I love what you just started with. And I feel like so much of what we do is behavioral finance and then of course applying our trade to that.
For us, it's I always talk to clients about being very rules-based. So what are the rules that we create? Or for clients, we call it our investment policy statement. But what are these rules that we create? And then we abide by them. I like the doctor comparison because in those situations, like when someone sees blood and panics, they freak out. A doctor is trained to know not to do that, to know the exact thing that they're supposed to do in that moment. I think for us, the emotion that typically is comes up for grabs when it comes to money is fear and greed. Like you're always playing on those two sides of the coin. Those things are at an all-time high when it comes to money. And the behavioral finance side of it is we're trained to know and to talk through clients about how to work through those emotions. And if we create these very systematic rules that we put in place for, let's say, their investments, hopefully we're able to override that maybe irrational side of thinking.
Yeah, and I think rightly so someone feels that way. I mean, this is their hard-earned money, and this is money
True.
that needs to last them theoretically their entire lives, and we need to subside that fear of outliving your money. And I really agree with what you just stated. A lot of that just comes down to creating a plan, and we talk about it oftentimes in our meetings. It's like, hey, we're taking a road trip across the country. At the very beginning of our road trip, we need to know, are we supposed to go north, south, east, or west? And that's sort of that very beginning foundation to be laid. And then once we get on this road trip, we know, okay, if we're going from Florida to California, we're going to head west. We're going to take I-10. I'm just making numbers up here at this point. And hey, if we have to get off somewhere because we have a flat tire, we know those specific points that we can get off and put that tire back on and inflate it and get back on the road again. And really kind of taking that as that long-term plan. If there's a plan in place, we know what to do during times where the market is trending backwards, or in a really worst case scenario, which we're going to talk about in more detail, like where the market is flat for a number of years. I've often said, hey, the market goes up big, everyone's happy. It goes down big, we can explain that, and there's oftentimes opportunities in a big decline. When it moves sideways for a number of years, I think everyone just sort of looks and is like, what are we doing here? And they forget, hey, there's a bigger picture involved, and they get really stuck on that small picture of, gosh, things haven't really moved a lot. Are we going to hit those goals down the road? And a good plan really looks at all of the various potential outcomes and assigns us, a percentage or at least an avenue of how do we make this work.
I think we all run the risk of looking at life in a short-term window. So it's easy for us to say, hey, we're planning for decades in advance for people most oftentimes. And so, but it's still easy to live in, gosh, I saw this on the news. This is happening right now. I'm hitting the panic button. I'm freaking out. Like, we live in this short-term now mentality. A lot of the conversations I'm having as we're recording this, almost middle of November of 2023, a lot of the conversations I'm having already are about the election year next year and what that's going to mean. And let's going back to the roadmap analogy, where maybe you have a flat tire that you need to change, or you take these detours. If we look back at the map for the last 5 years, I don't know how much detail we need to go into, but like, I remember at the end of 2018, we experienced market volatility. In 2020, of course, everybody knows what happened in March of 2020. I mean, we had the largest drop in the shortest amount of time. I think it was like more than 30% in 3 weeks on the Dow Jones. I mean,
it ended up positive.
At the end of the year, right?
Was actually a fair. If you took that major drop out, or if you did not panic during that and did not move to cash and try to time this whole thing in and out, if you just sort of stayed the course, which was what our method, what was our philosophy at the time,
yeah,
and you actually had a fairly decent. Yeah, it still is that philosophy, but you actually had a fairly decent year that year, but short of that, there wasn't too many more past that.
Yeah. And then, okay, so then let's fast forward to what everyone, again, we have this recency bias of all the things that have happened to us recently or what's upcoming soon. When I look back for the last less than 2 years, like I go back to the beginning of 2022, we have this I just remember it as a very interesting time. Like that Q1 of 2022, all these reports were starting to come out, which we weren't necessarily surprised about, but we had inflation running wild. It was this uncontrollable number that everybody was concerned about. We had a war happening, starting in Ukraine. And at that time, like January 1 of 2022, the Fed funds rate was virtually zero, if I'm not mistaken.
Mm-hmm.
Fast forward to today, and there's a lot of life that happened in between that. But if you fast forward to November 2023, it's, 5.3? Do you have the number? It's like 5.3 to 5.5, something like that. And so that had a massive impact for people. And most of the time when you hear that, everyone associates that with real estate, because they're like, well, the 30-year mortgages touched like 8% last month, and they've come off a little since then. But what we experienced, and what retirees, clients that we worked with experienced, was how that impacted their bond side of the portfolio, which is always supposed to be very stable. It was this unprecedented rise by the Federal Reserve. And the move was effectively to manage and deal with inflation. Do you want to talk to that one a little bit? Because I
Yeah,
think that's what's on everybody's mind over the last, 15,
that
18
sword that
months.
sword definitely cuts both ways, right? Our cost to borrow has gone up significantly. And what was the purpose of that rise? I think it's important, and this is where Michael Scott in our office really would come in and give us a very
Shout
detailed
out.
analysis. But I think our simplistic overview of it is, the Fed was doing their best to curb inflation, and the way you do that is you attempt to slow down the economy, and the way you do that is you raise rates, make the cost of borrowing more expensive for companies, which theoretically maybe there's various things that go into this, but slowly begin to slow down the economy. So that sword cuts both ways in that it's costs more to purchase a home. It costs more if you're, funding your life through credit cards or using some other debt mechanism. But for our clients inside of the portfolios, there's two things that really occurred. One is the value of bonds, which have historically been fairly stable and never really have hit a grand slam, really had a major push backwards. And that led to a lot of conversations. Do we get rid of bonds? Well, bonds are meant, there's a reason that we have fixed income inside of our portfolios. And that income is there for, maybe it's for income purposes. It's for theoretically some stability, some diversification away from stocks. So there's a purpose to having it inside there. But when interest rates rise very rapidly over a very short period of time, you're going to see a negative rate of return on those fixed income. Some of the things that we try to do is shorten that duration, shorten the
Yeah.
length of those bonds to minimize that risk or to mitigate it a little bit. But the upside is that, hey, listen, our money market rates are pushing 4.5%, 5%, and that is hopefully to combat a little bit of the inflation that's incurring. But you know, last time we talked about a 5% money market. I mean, goodness gracious, I've been in this business since 2000 and oh my gosh, I
2?
hate to say three, but yeah, it's the 20th year. I can
Yikes.
remember only a very handful of years that we were, trying to find the best performing money market account. Other than that, it was, 1 or 2%, if that.
And I started in the industry during the Great Recession of 2008. And something that I learned, and I want to explain this analogy because I think it's helpful when it comes to bonds. Because, like, hearing you say, oh, okay, well, rates went up, bond values went down, that is a little confusing to, I think, fully wrap your head around. And the best way that I've learned it over the years, going back to early on in my career, was, if you think about it, like, if you're buying let's say you're in the market for buying a $10,000 bond from a company, and the yield on that bond is 4%, and you buy that, right? Like, you buy that bond, and 30 days later the rates go up. Fed raises Fed funds rate over the next 30, 60, 90 days, and that same exact bond is no longer at 4, it's at 4.5%. And I'm looking now, I'm in the market to buy a bond, and so I want to buy a $10,000 bond at 5, not at 4. These are extreme examples, but just kind of making the point. And Matt, you come to me and you're like, no, John, hey, don't actually buy that bond directly from the issuer at 5%, $10,000 denomination. I'll just sell you mine. And I'd go, what are you, crazy? Like, I'm not going to buy your bond I know you just bought it, but I'm not buying it from you because you got you're getting 4% on that bond. I can go get a brand new bond at 5. Like, the prevailing market is now 5%. And so the only way that I would ever agree or consider to purchasing your bond from you is if you sold it to me at a discount, right? Like, you paid 10,000 for it, but you say, hey, you know what? I'll take a haircut on it. I'll sell it to you, John, for 9,000 so that I can unwind this. I need to get out of this investment product or something. I know that's like an extreme example, but it kind of helps for me when I explain that to clients, give that frame of reference of like, oh, okay, so yields, like, rates went up, and that means the prevailing bonds that we own, potentially the value of those went down. Does that make sense?
I love that analogy, and
Okay.
I
Thanks.
use the same one, but then I have to talk about length of bonds because I think that that's just as important as the
Yeah.
conversation you just had. So I look at more of like a seesaw, back in the day in the seesaw. So a very short, do you remember doing this? Riding that seesaw, going up and down, your buddy on the other end, and then he or she just jumps off of it, and it comes right up and smacks you. Do you remember doing that? I mean, I distinctly
Yes.
remember that. I probably have
Yeah, of
scars from that.
course.
So let's use that analogy and let's go with that. So if that seesaw is really, really short, so your buddy is like within arm's reach from you, and he or she jumps off of it, kind of no big deal, right? You could kind of get off at the right time. That short seesaw, no big deal. But as the longer the seesaw is, and you're at the top or you're at the bottom and your buddy jumps off and it comes up and it just kind of smacks you, the longer that is, the more painful that impact is. And that's a really great way to describe what's happening in the bond market.
I think
So
it's hilarious. I just see us like, Raina hearing this and she's like, "Hey, we're gonna do a little marketing campaign. You and Matt are gonna be on a seesaw at the
we should
park,
have
and
definitely
you're gonna explain how this works while you're actually on a seesaw." I
we
just don't
should
know who's the one
do
that
our
jumps off.
podcast. Yeah, we should do this on a that would have been a
Oh
very
my
good
god.
visual for this. Okay, so anyways, back to this. So let's continue with my analogy. We just did yours. Now it's my turn. So let me speak. Here we go. So the long seesaw, more pain, more movement up and down, and that's the great way to describe the length of these bonds. So what can we do as interest rates begin to rise is we can shorten the length of the bonds that we're buying. Instead of buying a 20 or 30-year bond, we can buy a 1 or 2 or 3-year bond. Still going to have pain, right? There's still going to be movement up and down, but we do what we can to mitigate that. So let's talk about the other end of this, John. Interest rates have, and again, we're not prognosticating, I think, on this podcast, but pretty close to peaking, right? Fed funds rate you just mentioned is about 5.5%, the cost that banks charge each other to lend money back and forth. Could go higher, definitely could. But let's just hypothetically say today's the peak. And let's just say the Fed sees enough, the folks that control our economy and our interest rates see enough and say, hey, listen, okay, it's high enough. Let's start coming back down again and let's start this economy back going. Let's just say it slows down. And it moves in the other direction. So let's use your same analogy there, John. Interest rates are now coming down. You have your 5.5% bond, and new issues today dropped to 4.5%. How does that analogy work on the downswing?
Oh, you're asking me? I'm listening.
Now it's your turn.
You have me mesmerized. I was just listening and watching. So yeah, it's literally the opposite, of course. So as rates start to go down, the value of those bonds that we own go up in value.
Exactly.
And yeah, go ahead.
Yeah, so that's why I think the whole point of this particular conversation is why we don't abandon our approaches, right? Why do we not get rid of bonds when interest rates rise? Is the same reason why we don't get rid of stocks when the market goes down. It's meant to be part of an overall portfolio, and it's meant to have rebalancing. It's meant to have some small changes and maybe some big changes depending on where your life goes. But the abandoning of our portfolio and abandoning of portfolio theory does not happen because an asset moves up and down in value. It gets adjusted and small, minute changes take place. And that's the message we really want to get across to clients and those that are listening to this, is that making large changes based upon rear view looking policies is a recipe for absolute disaster. You've got to be forward thinking and you've got to have a plan. And with those two things, along with budgeting, along with organizing your finances, along with some of those very basic ideas that we kind of discussed in previous episodes, you blend all those together, it's really hard to mess things up too badly.
Well,
And
this is why we preach. This is why we preach diversification, of course, and flipping the conversation to stocks or equities. You look at 2022, and it really was this perfect storm of interest rates go up, bond values go down, and so I think the Barclays Ag which is sort of it's a composite view of bonds, was down something north of like 14 or 15% last year. And then on top of that, you had stocks going down as well last year. But to your point, and there are a multitude of reasons why that happened, but to your point, we don't abandon that strategy because that level of diversification, when stocks do well or they go up, like you can't. This is a conversation I have not so much with clients, but like when friends come to me and they're like, "Hey, what are you doing? Like, what are you guys doing right now?" And I think sometimes people have this perception that we're like, "Oh, we're all the whole portfolio is in cash now, and now the whole portfolio is in cryptocurrencies or something crazy." It's having these extreme swings of the pendulum from one direction to the other is never that's not how a sound strategy is based upon. It's based.
You notice that those people around you that do those big swings, you hear only about the good stuff, right?
Yeah.
You never hear like, "Oh yeah, I swung in the wrong direction and just had a humongous whiff." Kind of going back to your point, John, And I'll use the Dow Jones just as you talked about the Barclays aggregate from the fixed income side. If you look at the Dow, just as a metric, I don't think it's what we are judging things against, but I think it's a benchmark, right?
Everybody listening to this podcast has heard of
Yeah,
that.
they know the Dow
It's
Jones. It's a collection of 30 stocks that are large cap stocks here in the United States. Over the last 5 years, the Dow Jones stocks are up, I don't know, let's just call it 35%, just to make math easy. I think it's 33%, but I'm not great with math, so I want to just keep it really
yeah, you better be.
So I'm supposed to say that out loud? No, I am really good with math. But let's just say it's 35 so I can keep my numbers easy. And you say, okay, last 5 years, the Dow Jones is up 35%. Wow, 7% a year is what the rate of return is. Man, fantastic. We know that that's not what happened. That's not the way that it worked. Over that last 5-year period, I think if you looked at calendar years, the market was up 2, maybe 3 of those 5 years.
Mm-hmm.
And part of that was 2020, which had huge swings, as we just talked about a moment ago. So how do you get that 35%? Well, you don't get it by sliding it out. You had to go through the tough years. You had to stay committed to your plan. You had to have a good diversification strategy. You had to make sure that you were not putting all of your eggs in one basket. You were not making these major swings after a bad year, moving to cash, and after a good year, adding more to the portfolio, keeping a very good plan in place. That's how you end up capturing that rate of return. Again, not by going to the casino and betting it all on black. It's by having a plan. And I always have to kind of remind our clients of that, because if you're watching CNBC and watching, some of the talking heads on there, they're there for show, right? That's entertainment in a lot of sense. And we have to remove that from reality, because not all times it's reality based.
I feel compelled to do a little bit of simple math to just shed some light on what you talked about, because I get this question a lot, and I think this is important. It's like, portfolio is up 30%, it's down 30%. That's the same thing, and it's not. So really simple math. Like if you have $100 and that $100 does the hypothetical, of course this isn't real, but that $100 has a 50% gain. What is the result of that $100? The $150, right? But the problem about losses is that you only need about a 33% loss to be back to square one with that $100, right? So $100 grows by 50%, becomes $150. Then the markets drop down 30, like let's call it 33%. You're from 100, 150 back to $100. So in other words, avoiding a 33% loss can be just as valuable as achieving a 50% gain. And I think that's where diversification becomes so important. We put these rules in place because, it's impossible to know or to prognosticate what's going to happen, like you said. But when you were talking about the Dow and looking at average returns over a 5-year stretch, I think that's part of the roller coaster that people tend to forget when they look at an index and like, oh, it was up this number. It's like, yeah, but what does the actual invested dollar amount look like? And I use that simple math a lot of times for people, because it helps people realize like, oh, wow, I didn't realize that, it's not a 50% loss. It's less of a loss to get back to the same number.
Yeah. And again, it's math. It's math based. And I think, again, a part of our job is to be able to explain that, to describe it, to have people understand what's happening with their finances. I think as we kind of pivot to the next subject, I think it's important for a client to know what phase of life they're in. I think that sounds sort of silly to say it out loud, but we have those clients that we label as accumulators. And that is someone who's still in the workforce, someone who theoretically has excess earnings and is adding to their portfolio, adding to savings, building for tomorrow, living for today as well, but building for tomorrow. And then we have our clients who are income producing, clients who are retired. And that's a completely different strategy. And I think it's important for us to kind of dive into what those two, what are some of the keys for both of those groups of people, those who are accumulators. So let's start with those. And those are typically our clients who are, below age, call it 60. And they might be in their 20s right now, and they might have had their first job, or they might, be accumulating money inside of their 401ks, maybe doing their IRAs. Maybe we have a small business owner who's putting a lot of money back into their company. There's a lot of different labels that we can apply to them, but accumulators in general really should have their eye on the long-term prize. And that long-term prize, again, is making sure that there is a plan. That plan needs to have a lot of contingencies built into it. So in case someone's laid off, that there's sufficient savings, that we're not tapping into credit cards. We're not, having to borrow our way out of a problem. So we need to make sure that that is there. Really good organization. We know where all the accounts are. We can account for them. We know what's inside of each one of these accounts and what they're doing. But really looking more for a longer term picture and looking less at a 1 year or 2 year or what's it doing today, rather than, hey, if I continue this and I get a little bit of help from investing, this is where I'm going to be at the ending point. And I think
Yeah,
that that's really important.
I think for those folks, I talk to them about leaning into the things that you can control. So when there's all this chaos around you of market volatility or concern about the economy and these things that are stressing you out, well, what can you control? You can actually lean into not only continuing to fund your retirement strategy, but maybe even adding more dollars to it, knowing that you're potentially buying in securities or in the market when it's at a bargain, when it's at a good price point. And on the flip side, if it's okay if I jump to that, for the retiree segment of the clients that we serve, where we're having a lot of conversation, it's almost the opposite. When we're having market volatility conversation, it's like, okay, well, what can we control? Can we control maybe the withdrawals, the distribution? So no longer are we adding to the investment portfolio. We're in this phase of life where we're now taking from it. We're living from it. And so can we control that number, maybe reduce the withdrawals we're taking? And in either one of those scenarios, it goes back to budgeting. When we talk about what are the things you can control, it goes back to your budgeting. And this is a bit of a shameless plug, but we're at the final stages of an e-course that we're creating, where there's a total section dedicated to how your money flows. And it's all about, the monies that come in the door and out the door, and how you budget and how you cash flow and how you see your money. And I feel like that is probably the single greatest thing that someone, no matter what phase of life that they're in, that they can influence. Because then ultimately, if you're, let's say the example you gave, you're in this build or accumulation phase of life, you're growing, you're adding. Well, if you can control the budget and find ways to save and add more in those scenarios, even better.
Absolutely. And I think something that is characteristic of the accumulator is that most of the time they're not putting large lump sums of money in, but it's happening on a monthly or quarterly basis, right? So again, less concern about timing the stock market or timing the bond market or timing any investment. And it's more of just kind of put your head down and keep doing it. I think on the retiree side, I love the words that you state, because I use it a lot. There's lots of things to worry about in this world. Let's just worry about the things that we can control. And we can control our allocations and our exposures and where the money goes, but we can't control rates of return of a market, of an indices, of an investment. And I think, to your point, there are a number of tools in a high interest rate environment we're in right now that really does favor the retirees. And I think some of them listening to this will say, well, yeah, that's great, Matt, but also the price of goods and services have gone up. And I would say, yes, back to the budget. Maybe we have to kind of pull back a little bit right now when the price of milk and eggs and all of these things, we go to Publix or we go to, our grocery stores and it's more expensive. Maybe we buy a little bit less right now. And then when inflation subsides itself, we can kind of pick back up again. It goes back to the budget. In 2020, when the world was coming to a screeching halt, the Marcuse, we looked at our budget and said, okay, what is everything that's essential and what is not essential? Eating out is not essential. Buying things on Amazon, although is somewhat essential, it was not essential. Let's lock this whole thing down and let's just hunker down for a bit. Let's just see how long this happens for. We have no idea. And we can sort of control where our expenses are. And I often say that a lot to our retirees. The other thing that I get from retirees a lot, John, and you might get this too, is, hey, I'm retired. Let's put all of it inside of a fixed income. That's what my parents did. That worked, served them well. And let's just pick one strategy and go with it instead of diversifying. And this is one that I get a lot. And I think a lot of it has to do with the behavioral finance side. And maybe that retiree right now was born in the late 40s, maybe early 50s right now, maybe even mid 50s. And I have to think about what was happening there when they were growing up, right? So if they were born in the 40s or 50s, they were kind of, I'm seeing my son now who's 10, my other son who's 7. They're starting to kind of like understand like the way things work a little bit. So if I'm putting myself back in those retiree shoes, born in the 40s, born in the 50s, that means they were kind of growing up in the 60s and 70s. What was happening in the 60s and 70s in our country? And it mimics a lot of what occurred these last 2 years, where you had high inflation, you had very high interest rates in the country. And what happened as things progressed year over year? What were interest rates doing basically from the 80s and 90s all the way through the last few years? They were coming down, right? Interest rates were really low after that huge rise in the 70s and early 80s. So bonds did, and fixed income did really, really well during that period of time, because you had this massive pullback of interest rates and inflation was subsiding. And so, again, some of that's coming back to itself, which is why we don't want to abandon our philosophy of our portfolio and our portfolio construction, because we don't know what tomorrow holds, and we want to make sure that we don't just have all of our eggs in a single basket, but we have them spread out as much as we can to accomplish the overall goal, which is making retirement happen and hopefully not running out of money.
Can I go back to one thing that you said? So of course, in no matter what phase of life you're in, budgeting and being mindful, and like you said, the Marcoux family in 2020 hunkered down, was very mindful of where spending was going. I want to share this too. No matter what phase of life you're in, nobody is exempt, in my opinion, from needing a emergency bucket.
Mm.
You have to have an emergency savings number. Conventional wisdom, that we learn when we go through, our advisor training and becoming certified financial planners, is that it's 3 to 6 months worth of expenses. But maybe that's more for you. Maybe in retirement you feel that you'd be at a place of peace and comfort having it be 9 months or 12 months. I don't know what the number is, but I can say this universally: you need one.
Mm.
Because that is, the average American right now, the savings rate, by the way, is 4.1%. So we talk about finding ways to budget to save more for the accumulators. 4.1%, we can do better. And the average American is carrying like $5,000 to $6,000 of credit card debt at any given time, and we're maybe 2 paychecks away from bankruptcy. The average American. That's, I mean, of course, there's circumstances that call for that, and that's, life circumstances, be it as they may, like those things happen, but no one is absolved from needing an emergency bucket for all the reasons I just shared and everything we've talked about for the last half hour, I think.
Yeah, it's such a great point, because where do you go when that air conditioning blows up? Where do you go when, there's a medical incident and you need to cover your deductible? Where do you go for those things? And if the answer is I go to credit cards or I build debt, that's not a great answer, right? The answer is I gotta have a place. And the nice thing about having higher interest rates right now, again, the downside is the inflation and things we talked about. The higher side is that money market account and that side emergency account should be having a little bit of a push, of a little bit of a tailwind behind it, and getting and making that grow even a little bit, even though historically that has not been really an account or a priority of our savings accounts, is to have them earn anything. It's really there for us when life rears its ugly head and we have to tap into it.
I really enjoy this conversation, because at first I thought we were going to spend probably the majority of our time just talking about put that diversification in play, have that plan for your investments, and continue to monitor that and stay the course, which is true. Of course, that's good advice. But I think where we ended with was really focusing on these things that you have daily control over, like your budgeting, your spending, where money's going. And as we wrap today, what do you have any just final parting words of wisdom for our listeners? Just a
Yeah.
couple money tips or anything that you'd like to
This
share?
podcast today was so easy because it's things that John and I say every single day. And
Right.
if you're a client and you've listened to this entire show, you've heard every single word that has come out of my mouth or John's mouth. You've heard this in a meeting. We typically meet with our clients somewhere anywhere from 1 to 4 times a year, depending on the need and necessity. I find myself in even some of those that happen every 90 days, saying the same things over and over again. And I have no problem doing that, because we're reinforcing really good, strong financial concepts that we need everyone to remember. And I know how busy our clients are. 90 days for them, they've felt sometimes have lived a lifetime in that 90-day period, and they don't remember the words that I said, 6 months earlier or 4 months earlier. And so I have no problem repeating myself, and I have no problem reinforcing the why. And it all comes down to the why behind we do what we do. And it's really a lot of what we do is financial education. Now we execute it after that, but we first have to teach people what are some of the really smart money management tips that for our combined 35 years of experience that we have seen. We have such a unique perspective of being able to see 250 different groups of people and how they've lived their lives. And from that, we take the bits and pieces from each one of those and we build this perfect avatar of the way to do it. Now, not everything's going to fit into this perfect little bubble, but we have such great experience of being able to see the ones that have done it right, the ones that have stumbled along the way, and what were the attributes to both of those. And let's make sure we avoid those stumbles and that we reinforce the ones that really made it work well, that have struck that balance between saving for tomorrow and living for today, have had savings, have had a budget, and have had a financial plan that is moving with them as they go through life.
I love that. Amen.
Matt Marcoux for president.
Amen. 2024. Well, I'm gonna wrap it with the stock market is like a bad cold. And I this is silly, but also very something I've experienced in the last 2 weeks. I've had this head cold that, as you know, I cannot seem to shake. And anyone who's had that before, you ache, you're stuck in bed, you're tired, you don't feel good, and you pretty much convince yourself, every day you wake up and it feels worse. You're like, is this ever going to get better? And then a few days go by and, the illness kind of starts to go away and you recover. And maybe the recovery takes longer than you expected. But at the end of the day, there are brighter days ahead. And I think the stock market's like that. Another analogy I love using is that it goes up like a stairs and down like an elevator. But we can't control when that's going to happen. Maybe over longer stretches of time in a more normalized market cycle, it'll go up over time, but it goes down like an elevator. It feels like anyway, oftentimes. And so to everything that you shared and that we talked about today, it's having that plan, controlling the controllables, that is what is so, so important. So thank you everyone for listening to us here on Above Board with Canterpath. We are only a couple episodes away from episode 100, which blows my mind. And then at the beginning of 2024, we're coming back at you with a new season 3, and a refreshed look. So we'll share more as we get there. But thanks again, and we'll see everybody next week. See ya.